Hello there, this is Victor here. Welcome to the Intelligent Research channel. Do you know that the Silicon Valley Bank SVB's failure was already revealed or even shown months ahead before it happened? And do you know that you could predict SVB's bank run if you look into SVB's financial reports? So in this video, I am going to explain why SVB Bank failed, what triggered SVB's bank run. Specifically, I will talk about what are the biggest red flags shown on SVB's latest financial reports that predict the SVB's failure. Also, I will show you what stock I bought recently during this banking crisis. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog. I've posted the link in the video description. Once you become a premium member, you can follow all the stocks I'm buying every month, follow all the stocks I'm investing in for the long term, and download the latest intrinsic value calculator so you can estimate whether a stock is undervalued, fairly valued, or overvalued now. Also, you have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. So why did the Silicon Valley Bank fail and what triggered SVB's bank run? SVB Bank fell because management made a huge mistake of investing a large percentage of short-term deposits in long-term US treasuries and long-term government bonds. This is a banking 101 mistake. SVB's management did not do enough to manage interest rate risk properly. When interest rates started increasing quickly in 2022, SVB's held-to-maturity bond portfolio started taking huge unrealized losses. SVB's held-to-maturity bond portfolio was initially worth $91 billion, but as interest rates started climbing quickly, this $91 billion held-to-maturity bond portfolio was underwater and had $15 billion unrealized losses. The biggest risk is that if SVB customers started pulling out money quickly, SVB will not have enough money to satisfy all the deposit withdrawals, and SVB will be forced to sell its long-term bond portfolio at huge realized losses. This is exactly what happened afterward. Another problem is this: around half of SVB's customers are VC firms, private equity companies, and startup companies. These customers had a lot of cash to deposit at SVB during the peak of the pandemic, when money was very cheap and when interest rates were near zero in the US between 2020 and 2021. But when interest rates started climbing quickly in 2022, many SVB customers started withdrawing a lot of deposits from SVB because they needed cash to sustain their businesses. The bank run started when many SVB customers heard about SVB's problems on Twitter and from their friends and colleagues. Of course, SVB did not have enough cash to meet customers' withdrawals, so SVB had to sell its bond portfolio with a book value of $24 billion to Goldman Sachs at a huge $1.8 billion realized loss. This was a huge red flag for many investors and SVB customers. This triggered a huge bank run on SVB. Now, SVB is the second biggest bank failure in US history. If you look into SVB's financial reports over the past 3 years, you could predict SVB's banking failure was only a matter of time. SVB released its latest earnings report on January 19th, almost 2 months before this huge bank run. Here are the biggest red flags I found on SVB's financial reports. If you look at SVB's financials here, you can see SVB grew too fast between 2020 and 2022. For example, SVB grew its total assets from $116 billion in 2020 to $212 billion in 2022, which is almost double within 3 years. This is a huge red flag because banks in general should not grow this fast, even for a smaller regional bank. During this period, SVB's total deposits, which are liabilities to SVB, grew from $102 billion in 2020 to $173 billion in 2022. Again, this deposit growth rate is not normal. Here's a huge red flag. If you look closely, you can see SVB's non-interest-bearing demand deposits grew from $67 billion in 2020 to $126 billion in 2021. Then this drops to $81 billion in 2022. This shows customers started withdrawing a large amount of money from SVB in 2022. Here's another huge red flag. SVB's short-term borrowings increased from $71 million in 2021 to $13.6 billion in 2022. SVB only had $13.8 billion of cash by the end of 2022, without even considering other liabilities and customer withdrawals. This means SVB only had enough cash on hand to cover short-term borrowings of $13.6 billion. Another huge red flag is this: SVB's held-to-maturity securities grew from $17 billion in 2020 to $91 billion in 2022. This shows that SVB invested most of the customers' short-term deposits in long-term government bonds between 2020 and 2021 when interest rates were near zero. When rates started increasing quickly in 2022, this large portfolio of held-to-maturity securities had a $15 billion unrealized loss by the end of 2022. This is a huge mistake because SVB was chasing higher yields in 2020 and 2021 when interest rates were near zero. Of course, when interest rates increase, bond prices would decrease a lot. SVB's management did not manage interest rate risk enough and did not keep enough cash in case many customers started taking out deposits. Here's another red flag that is not known by many investors. Because of accounting rules, this unrealized loss of $15 billion is not properly reflected in SVB's earnings because this $91 billion bond portfolio is supposed to be held until maturity. The lesson is this: if SVB held enough cash on hand and did not invest most of its short-term deposits in longer-term bonds that are very sensitive to interest rate changes, and if SVB's customer base is more diversified, SVB would not have a huge bank run. I think SVB's management was too greedy to chase higher yields during 2020 and 2021 when interest rates were close to nothing. SVB did not diversify its customer base enough. More importantly, SVB's management did not manage interest rate risk well enough. This is a banking 101 mistake. So what stock did I buy during this banking crisis? I'll show you one of my personal gold stock portfolios here. I also have other stock portfolios with almost the same stocks and the same investing strategy. Recently, right after SVB failed, there was a large sell-off across all the banking stocks and all the financial stocks, so I bought 10 more American Express shares in this portfolio. I decided to invest in American Express for the long term because I like its wide economic moats in the payment network industry, its wealthy customer base, its branding, its closed-loop payment network business model that is very hard to duplicate, and its long-term business prospects. For example, even in this high inflation market, management expects that American Express can grow its revenue in excess of 10% each year, and expects EPS can grow mid-teens over the next several years. Based on my intrinsic value calculation here, I estimate the American Express fair intrinsic value to be around $175 per share. Also, Morningstar estimated American Express fair value to be around $169 per share, which is very close to my intrinsic value calculation. This means I believe American Express is slightly undervalued at the time of making this video. American Express is different from most banks. American Express has its own banking subsidiary, but is still mainly a payment network company. American Express runs its own closed-loop card payment network that connects both merchants and Amex card members. Compared to Visa and MasterCard, most American Express card members and customers are high-income earners. Amex customers are generally wealthier and have better credits than the average consumers, so Amex customers' delinquency rates are generally lower than other average customers. For example, according to Seeking Alpha here, Amex US consumer credit card delinquencies in February were marginally higher at 1.1% compared with 1% in the prior month. Net charge-offs dipped to 1.4% from 1.5% as of January 31st. This is my prediction and my opinion here. Even if there's a recession or a banking crisis, Amex credit portfolio and loan delinquency rates should not be as high as other banks because Amex mainly focuses on high-income earners that are wealthier and have better credits than most consumers. Also, if there are more bank runs, I think it will mainly affect the smaller regional banks. The systematically important bigger banks should benefit the most from this banking crisis. Based on what I know, American Express faces much stricter rules and capital requirements than the smaller regional banks. Unlike SVB Bank, which failed, American Express customer base is much more diversified in many different industries. SVB's main customer base was VC firms, startup companies, and private equity companies. Warren Buffett is also the largest investor in American Express. He has been a long-term investor in American Express since the 1990s. Buffett completed his investment in American Express in 1995. The cost was $1.3 billion. Now his investment in American Express is worth over $24 billion. Buffett's investment holding company, Berkshire Hathaway, owns around 20% of American Express at the time of making this video. Now, all these are only my opinions and my analysis based on my research. They are not financial wise. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.